Ladies and gentlemen, good afternoon, and welcome to the earnings conference call of HeidelbergCement India Limited for the quarter and year ended 31st March 2026, hosted by PhillipCapital India Private Limited. As a reminder, all participant lines will remain in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone telephone. Please note that this conference is being recorded. I will now hand the conference over to Mr. Vaibhav Agarwal from PhillipCapital India Private Limited for opening remarks. Thank you, and over to you.
Thank you, Ryan. Good afternoon, everyone. On behalf of PhillipCapital India Private Limited, we welcome you to the earnings call for the quarter and year ended 31st March 2026 of HeidelbergCement India Limited. On the call, we have with us Mr. Joydeep Mukherjee, Managing Director, Mr. Anil Sharma, Chief Financial Officer, and Mr. Amit Angra, Head Investor Relations and Senior Vice President Finance of HeidelbergCement India Limited. I would like to mention on behalf of HeidelbergCement India Limited and its management that certain statements that may be made or discussed on today's conference call may be forward-looking statements related to future developments and which are based on current management expectations. These statements are subject to a number of risks, uncertainties, and other important factors which may cause the actual developments and results to differ materially from the statements made. HeidelbergCement India Limited and the management of the company assumes no obligation to publicly alter or update these forward-looking statements, whether as a result of new information or future events or otherwise. Also, HeidelbergCement India Limited has uploaded a copy of the Q4 and FY26 investor presentation on their website and stock exchanges. Participants may download a copy of the presentation from these websites. I'll now hand over the floor to the management of HeidelbergCement India Limited for their opening remarks, which will follow by interactive Q&A. Thank you, and over to you, Joydeep, sir.
Okay. Thank you. Amit, will you be operating the slides on our side, please? Thank you. Okay, I'll start off with the key messages. We continue to produce mostly blended cement in our operations. This is in line with our commitments to producing low carbon cement across our operations. Our alternative fuel usage also increased by 3% year on year, and we are now at 11% at a company level. Our share of non-grid power exceeded 50% during the FY. The EBITDA at 584 rupees per ton was up 10% year on year. We did repay interest-free loan of 687 million rupees, and the company is now completely debt-free. We have cash and bank balance of 4,037 million Indian rupees, and we continue to operate on negative net operating working capital. We have been declared as the preferred bidder for grant of 2 mining leases in Madhya Pradesh. This was a strategic move and a forward-looking move. And we did recommend a dividend of 7 rupees per share in our board meeting recently concluded. Okay. As an ESG overview, 97% of all the cement that we produce are blended cement. On carbon, we are now less than 500 kg per ton of cement, and this number is going down quickly. And this is also because we have been working on modifying our product portfolio so that it falls in line with our overall strategy of reducing our carbon footprint. On water positivity, we are at 4.8x water positive. As far as CSR is concerned, we have touched 21,000 plus lives during this financial year and improved the lives. And we are at more than 40% of green power in our overall power portfolio. As far as our financial results are concerned, It has been already circulated. So broad messages in this are that we are about 19.8% higher on EBITDA as compared to last year. At the PAT level, we are 35.5% higher. Our sales volume increased by 8.8% over the last year. And on EBITDA per ton too, we are about 10.2% higher. On a quarter basis, we had impact on pricing. There was pressure on pricing. So we lost about 105 rupees at the gross price level, and we had a 53 rupees impact on raw material, and a 25 rupees negative impact on others. And we did have some positives in terms of power and fuel and trade. But overall, QOQ, our decrease in prices were only partially offset by input costs. On a year basis, our EBITDA increase, this was mainly due to a decrease in input costs. On a year basis too, though the impact on price was lesser as compared to the quarterly basis. We did lose about 16 rupees overall on price, and there was an impact of 11 rupees on raw material. However, we had positive gains on power and fuel, freight, and other expenses. And so on a per ton basis, the EBITDA increased from 530 to 584 rupees. And this is for the complete FY. On working capital, as I have said before, nothing to add. We continue to operate on negative working capital. In case there are any particular questions on the data already produced, we can address them during the rest of the call. We have been pretty consistent in terms of our dividends, and this is driven by our operational cash flow. And on a face value of 10 rupees per share, we have now proposed a 70% dividend for the FY. On our share of volume, we can say that about 45% of our total volumes are dispatched through road. This is up by 1% on a year-on-year basis. AFR, I have already spoken about 11%. This is up by 3% on a year-on-year basis. Premium products portfolio, we are working on this and have been working on this consistently as a strategy for the last 3 years. And I am very happy to state that we have achieved the number of 52%. So 52% of our total trade volumes come from premium products. This is up by 9% on a year-on-year basis. And as far as the trade mix is concerned, we are at a 81% trade sale number. This is true trade retail sale, and we can say 19% is our B2B sale of the total mix. So we are consistently and continuously increasing premiumization, and we are optimizing our trade non-trade mix. On outlook, going forward, I can say the upcoming elections in Uttar Pradesh is going to provide a lot of impetus to cement demand in central India. We are, of course, now heading into the monsoon season where naturally the consumption shall be a little low. But post-monsoon and carrying on till the elections, in our relevant market, we expect very good demand. The geopolitical developments, particularly the West Asia conflict, is continuing to create uncertainty in global markets and commodity prices. We've already had some impact on petcoke and fuel prices. I'm very hopeful and confident that this impact shall be passed on to the market, as we have seen across other industries. Elevated headline inflation and currency depreciation does remain a concern. At the same time, there are tailwinds of increasing cement consumption in the medium term as well as long term. Also, because of robust domestic consumption, as well as the rationalization of the GST rate from 28% to 18%, which was done last year. So we do not see a problem with demand going forward. But yes, for some time, headline inflation and currency depreciation would remain, a matter which needs to be monitored very closely, especially if a company has significant expenditure on imports. The El Nino effect that we are seeing, the heat wave sweeping through the northern part of India and the central part of India, would pose a significant risk to agricultural output, rural demand and food inflation. But with the advent of monsoon, a large part of this is expected to be mitigated. And as I have said before, I am confident, even though with a little bit of lag, the increase in input prices, we shall definitely be able to pass on to the customers. I think that's all from my side. And I'll now hand over the floor over to Vaibhav and to my team for the further question and answer sessions.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, a reminder, if you wish to ask a question, please press star and one. We take the first question from the line of Rajesh Ravi from HDFC Securities. Please go ahead.
Hello, am I audible?
Yes, Rajesh, you are.
Yeah, hi sir. So just wanted to understand what is the clinker production in FY26?
You're talking about the full year or quarter?
Full year.
So we produced around 3.05 million ton total clinker production during the fiscal.
Okay, and did we also buy and sell clinker from outside? During the year, did we sell clinker also?
Yes. We have not bought any clinker. Our own clinker quantity is sufficient for the cement. Yes, we do sometimes sell clinker, but that is not so significant.
Understood. And sir, if we look at your number 3.05 million tons, then we operated at almost 95% utilization in FY26. So, what sort of volume growth one can look at on existing capacity over next 2 years? Our CC ratio also seems to have come down from peak of around 1.5, 1.6, 1.65, is now down to 1.5. So, what is the way ahead?
Rajesh, if you see our total cement grinding capacity, it is around 6 million ton. And at this moment, you are right that we are running around 90-95% capacity, but at the same time, like Mr. Mukherjee said, that we are optimizing our product portfolio. We are also reducing our clinker content so that we can reduce CO2 emission, as well as it gives us the further headroom to grind more cement. So we can say that, okay, at this moment we have sufficient headroom for next 1 or 2 years, and we expect that our cement volume growth should be similar to what the cement demand growth in the market, especially in India.
So what would be our cement to clinker ratio, sir, in Q4 and FY26?
So our clinker consumption ratio is around 60-61% of the cement, and I think we will be able to reduce at least maybe 50 basis points or maybe 100 basis points in year.
Yeah, I mean, just to elaborate and add on, we've launched a new blended cement where the clinker content is almost 17% low. And we are continuously ramping up production of the same. So we don't think it is going to be an issue at least for the next couple of years.
What is this product? 17% lower clinker you're saying.
Yeah,
so
it's a composite cement. It's a composite cement.
Acha, composite cement, okay.
Yeah.
And what are the cost levers you're looking at, given that the industry is also reeling under, almost 300 to 400 rupees cost inflation over next by Q2? In that scenario, there are any cost levers where your company
Are you asking about the next quarter?
Yeah, for H1, given the industry is looking at 300 to 400 rupees cost increase because of the surge in fuel costs and the packaging material, in that obviously part of it is passed on. But overall, do we have any like green power share going up or any other cost metric which can save you, give you cushion against the cost inflation?
So look, we anticipate that, in the near term, the next quarter, our cost could be impacted by anywhere between 100 to 160 rupees a ton. Okay, given our fuel mix and everything. The packaging bags, the impact which was there has now substantially reduced.
Mm-hmm.
I think, so what we are looking at is about anywhere between 100 to 160 rupees a ton, which we are confident can be passed on.
Understood. And any target on the green power mix? How has that been in FY26 and how would that be in FY27-28?
Okay, Amit, would you sit on that question, please?
So Rajesh, we have been working. If you see our presentation where we talked about our green power percentage, it has increased to exceed the 40%, and we have been working further to increase it. Yes, it is a continuous process. Now, if you ask that, okay, there will be significant increase beyond this, answer is no. But yes, there will be some small improvement is there in the green power. So come down the line, 2026, 27, 27, 28, our target to increase beyond 40%. But one lever we talk about, and we also said in past that we have the good flexibility with respect to fuel mix. We consume petcoke as well as coal, and whenever the petcoke prices or coal prices move in the direction which is not maybe favorable to us, immediately we either decrease or increase our petcoke and fuel consumption. So in the Q1 June quarter 2027, if the price of the petcoke will remain at elevated level as it today, we will further optimize our fuel mix. That will give us the benefit. And that's why in our case, the impact will not be like 300 rupees what the industry talks about. Our impact may be around 150 rupees on account of this petcoke and the diesel.
Understood, sir. And what is the linkage coal share in our fuel basket, sir?
It is sufficient. We need not to go to the open market in significant quantity. Our existing ones support us for our clinker production.
Understood. Yeah, that is why your inflationary expectation is lower. Understood. And so two things, just on the Dalmia winning the JP assets now, and they expect to operationalize it fully from Q2 onwards, thereby bringing almost 5 million ton of additional volume pressure in the market. And what is the thought process on that in terms of you being one of the central and eastern markets being one of the key markets? And second, what are the capex program which we are looking at? You had talked earlier or Heidelberg had plans to expand into Gujarat market, but we haven't heard anything on that front. Any major expansions which is in the pipeline over next 2-3 years?
Yeah. So we are setting up, and you might have seen in media, a blending unit in Khandwa. This is expected to give us about 35,000 tons of extra cement from that unit. That is immediate. That project is on right now as we speak. And we are investing around 120, 130 odd, you can take about 130 crores in that project.
Sorry, 130 what?
Yes. Sorry, I didn't get you. Are you
I missed
130
your
crores?
last point. 130 crores, okay.
Yeah. Other than that, we have, as I said, mentioned, we have also been declared as the preferred bidder for grant of mining lease. So we have a limestone block in an area of about 350 hectares in Riva and Satna. This gives us 62 million tons of cement grade limestone. And there's another block over 350 acres in Satna again, which has about 105 million tons of cement grade limestone. So we are the preferred bidders for that. And obviously this is all keeping in view the future expansions, but I will not be able to reveal right now on the exact plan.
Understood.
As of today, what I am in a position to reveal and confirm is our blending unit at Khandwa.
Understood. Anything on the Gujarat plans which the company had earlier talked about that they would look
No,
for?
we are still awaiting clearance from the government. It is still pretty much.
Oh, okay.
Yeah.
Understood.
It's not in
Understood,
our
sir.
hand right now.
Understood. I'll come back and thank you.
Thank you.
Thank you. Participants, please press star and 1 to ask a question. We have a question from the line of Vaibhav Agarwal from Phillip Capital India Private Limited. Please go ahead.
Yeah, thank you. Sir, I had a question on basically on the pricing. So you said in your opening remarks that pricing has not been, you have not been able to pass on the pricing to the extent of cost push in Q1, and even in Q4 pricing has been slightly under pressure. So, sir, in this regard, as far as we gather, North and West have been quite stable or better off in pricing versus Central India. And Central India has been suffering from a low pricing for quite a long time now. So what is the key reason? Is it the commissioning of new clinker lines by our competition? What is actually dragging because if the neighboring pricing is relatively better off, then what are the key reasons for pricing to be subdued in your geography? That's my first question.
So, Vaibhav, this is pretty normal. If you see wherever, companies bring in capacity, for some time the prices do remain under pressure. So we've had JK expanding in our region. We've had a Shree Cement operation which has gone online. We've got extra material from Ultratech who are ramping up their capacity utilization in the same area. So right now Central is no longer...
The question was actually this is Central India has been under pricing pressure for quite some time now, for maybe last 3-4 quarters. And this is not going away, so that's the reason I was...
No, I have not understood. Are you...
No, I am saying in terms of pricing, when you are saying that you will be able to pass on the cost push in Q1, you are confident of it. But then the pricing is under pressure, then in that parlance, I was asking the question that what gives you the confidence that you will be able to pass on the cost push?
So the cost push would be on everyone, right? I mean, if this is not passed on, then all the balance sheets are going to start looking pretty bad. And historically, we have seen that if there is a serious cost increase, it always gets passed on. Which is why, if you have noticed noted my earlier comment, I have said always with a lag.
Right.
Because different companies would have different kind of stocks and tie-up for fuel. But as soon as that cushion is gone, then it will start hurting. And obviously, people at 150 million tons, 180 million tons, and 100 million tons, for them the impact on the balance sheet is significantly higher. So sanity says that this will always happen.
So, but structurally, from going forward from here on, maybe in, say, for the next 1 year or 2 years, how would you see overall Central India pricing? Assuming expansions go on, JK Cement, like we mentioned, have commissioned. Now there will be some new plants also coming in. So, as far as your understanding, structurally, how will pricing move in Central India for the next 1 to 2 years? How would you see that?
I think if you are going to look at the next 1 year, I am pretty confident that it is going to follow what is happening in North.
Okay.
Okay, because most of the northern players are also suppliers to Central, and as you also know, there are no islands of prosperity in cement.
Yeah, right.
There is always spillover from one region to the other region. So, a parity keeping in terms, keeping view of where the cement plants are and where the markets are, is going to come in. But I'm going to be cautious enough to say that yes, for maybe the next quarter and before, the monsoon ends, the prices will be under a little bit of pressure. But I wouldn't say that that is going to be a complete killjoy. Because there is also now the big burden of the cost push. So I'm sure to the extent of the cost push, the industry would be able to pass it on. But beyond that, if you're asking structurally, is there going to be how much on top of that? That is crystal ball gazing. I'm not able to answer that question right now.
Understood, sir. Sir, my second question was on your, like you said, your opening remark that you were highly dependent on imports. From that perspective,
I didn't say we are.
Industry. Okay. I thought that you said. So as far as HeidelbergCement India goes, sir, how much is the import component, or what is our fuel mix as of now? If you can just spell it out.
I think wherever we do not import any...
Nothing. That's what I want to clarify. There is no imported fuel.
No, not at all. Nothing.
Right. Sir, third was on your merger of... Yeah.
Just to add on the pricing, what Mr. Mukherjee said, I think also appreciate one fact that the highest consumption state in India, UP, is going to be on election in next 1 year.
Yeah.
And for it is predominantly Central India players, so that will support significantly on the demand of the cement, and that should support us with respect to the pricing, because we have been selling cement and our target is to increase volume, either blended cement or our nearby focus market or home market. So we are pretty confident and positive that we will be able to pass on the cost increase, at least cost increase to market.
So, sir, in that perspective, what is your demand outlook for FY27-28 for Central India and for HeidelbergCement, just in case you have any guidance?
I'm sure that, this fiscal 2 in Central, the industry would grow at least by 7.5%.
Okay, so that is in line to the overall pan-India demand growth.
And I think by the beginning of the next calendar year, as we approach elections, it's going to get ramped up to maybe a little bit more. But I'm saying on an average 7.5% is not too much to expect.
So that's a given that 7.5% will happen as per you.
Yeah.
And okay. And sir, you have been indicating about in the past there's no talk of late, but in the past you have indicated about a possible merger of Zuari and Heidelberg. Any thoughts on that?
Well, again, I said it's a timing issue. If you would know, I mean, there have been some publications that have come out in the media also. We are, of course, building a 3 million ton integrated cement plant in Karnataka.
Right.
That is now underway, which of course is not part of this company as of now.
Yeah.
But, depending on the suitable time, yes, there are plans of eventually going in, for a merger of all the entities.
So, but any timeline which you can probably think of, maybe 2 years, 3 years?
Right now, I would be hesitant to spell out a timeline.
Understood. And sir, last question was on your blending unit. So, what would be your capex guidance for FY27-28 in terms of overall capex for HeidelbergCement India?
Total, I think we have already said about
65.
It will split into 2 fiscal years, 2027-28, part amount.
Right.
and then 27, 28. So 130 crore rupees put together in 2 years we are going to invest in that.
So 65 each year is it a fair, or like the first year would be light and the second year would be heavy on CapEx?
Yeah, first year would be lighter. It will be more backloaded because first year we will not need so much of capital.
And so this blending unit, I'm sure this will not form part of your capacity, right? Well, the capacity will remain at about 6 million ton in terms of the overall capacity for HeidelbergCement India. Would you take it as an additional capacity, or like would you keep your rated capacity the same?
Then our capacity, like we said, it around 35,000 ton per month. The cement capacity will increase.
Right. So can we presume that this is a capex? This would increase your rated capacity to that extent, 35,000 tons per month, which converts about like 0.4 million tons per annum.
Cement output capacity, yes, because as of now we find it difficult to approach that market because Damoh is quite far from that part of the market.
And so last, your volume guidance, like you have done 1.35 in this quarter, which is the highest ever Heidelberg has done. And since you're optimistic on demand, so can we achieve like a 90% utilization for FY27 or maybe 28? Are you confident of retaining these kind of volumes for upcoming quarters, obviously in peak demand periods?
On a yearly basis, yes. I think quarter on quarter it's a little difficult to predict.
Understood. Okay. So we have questions from participants in the queue. I will just hand it over to Ryan for him.
Thank you.
Yeah.
Participants, please press star and 1 to ask a question. We take the next question from the line of Shravan Shah from Dolat Capital. Please go ahead.
Hi, sir. Thank you. Couple of questions. So just to clarify, when we are saying the industry in Central India to grow at 7.5%, so for us, in terms of the official kind of a volume target, would be the similar 7.5%. That's what we are looking at?
I have not understood your question. Are you saying are we forecasting that we should be also growing by the similar number? Is that what you're asking?
Yeah.
We shall be in line with the industry growth in our region.
Okay.
Obviously, we cannot exceed that because we are, as you know, we are nearing our complete capacity utilization. But we shall be in line with the growth.
Yeah. And just to get a number clear, so in terms of the cement capacity as on today is 5.95 million ton, the Imlai and Jhansi, these two units. And in terms of the clinker capacity, is it 3.23 because some debottlenecking at Damoh was supposed to happen? So just wanted to confirm the number.
Yeah, the debottlenecking has happened. The capacity is going to come. The debottlenecking exercise is over.
So what's the current clinker capacity? Is it 3.23 million or 3.1 million?
Our clinker capacity is 3.1 million ton, and cement capacity is not 5.95, it is 5.7 is our cement capacity.
Correct.
In Central India.
Okay. Got it. And this both the new the MP one, whenever we will finalize, let's say, so obviously there also like a Gujarat in terms of all the approvals, environment, everything will be there. So just trying to understand, even let's say in next 1 year also we will start, this will be kind of a 3-4 year down the line, the actual plan to start.
No, we have already received the city. So we can expect this project to be completed within 2 years from now, maybe even earlier.
No, so this is the Khandwa one you are saying?
Yes.
Yeah, no, I'm saying apart from this, the Gujarat one, let's say, do you think that the environment clearance likely to be there in next 6 months, 1 year is possible? And if it, let's say, if comes post that we start, so will it take another 2.5, 3 years to actually the cement product?
Obviously, post PAC, yes, of course.
Okay, and there in terms of the capacity, the last time we were talking about 2.5, 4 million tons. So or still it can change, depends in the time
It
we will
can
decide?
change. Once we receive the EC and we look at the situation, that's when we decide it. That is not a number which is very firmly finalized as of now.
And this MP2 mines that we have won there also, whenever we will add new capacity, that will also be at least 4 years down the line from today.
No, it could be earlier. There is nothing like that is 4 years down the line. But as I said, as of today, I am not in a position to declare an exact date. But we have plans, very firm plans, and we are definitely going to start working on it.
Okay. And for this Khandwa unit, then we will have to kind of start buying the clinker, or still the current at a full utilization?
Our existing clinker would do.
Okay. And sir, just to clarify this cost increase, what you mentioned initially 100 to 160 odd, just to clarify, so in Q1 we are saying maybe 125 odd rupees kind of a cost increase because of the packing bag, diesel, and then the fuel. And then in overall in 1H, max 160 rupees kind of a cost increase that we can see.
Yes.
Okay. And currently, sir, just 2-3 data points, the lead distance for fourth quarter, FY20, fourth quarter and FY26, and fuel mix for maybe fourth quarter and FY26, so that will help us to understand in terms of the what you were highlighting that we can shift from petcoke to coal.
So our petcoke to coal, earlier it used to be around 60-65% was the petcoke and remaining coal and alternative fuel. Now during last maybe 2-3 months we have reduced the petcoke consumption by around 10%. So the coal consumption increased from earlier 30% to 40%. So that optimization we have already done, and hopefully that should continue in June quarter. And in terms of your question with on lead distance, our lead distance currently is around 372 kilometers.
372. This is for the entire FY26, and what was the number for Q4?
It's more or less same. Our lead distance has not changed, although during last maybe 6 months increase around 5 kilometers, but there is no significant increase or decrease in the lead distance.
And the Kcal cost on a combined put together everything for fourth quarter and FY26 is how much?
Petcoke earlier used to be around maybe expensive 10%. Now currently it is really expensive 30% over coal. Coal Kcal basis is around 1.5 and petcoke now exceeding 2.25.
No, I got it. Petcoke. But actual, what was the actual blended Kcal cost for fourth quarter FY26 and FY26 full year?
Okay. I am talking about this current prevailing cost price, which is after the escalation or elevation of the petcoke prices. But if you talk about the only March quarter, the coal cost was below 1.5, which is more or less similar now as well, and the petcoke price was around 1.9 Kcal.
Sir, still I did not get at the blended level for us for fourth quarter and FY26. What was the Kcal cost? Everything put together, what was the blended
Kcal cost? Exactly.
You're talking about the put together both?
Yeah, put together for fourth quarter FY26 and for entire FY26.
That I need to recheck.
Okay. Got it, sir. Thank you.
Thank you. Participants, please press star and 1 to ask a question. We take the next question from the line of Rajesh Ravi from HDFC Securities. Please go ahead.
Hi, sir. Regarding the clinker debottlenecking, in the last call, you had suggested that the 1.3 lakh ton clinker debottlenecking would be up and running by June quarter, last year June quarter. So now you're saying that it is still due from 3.1 to 3.23.
So our debottlenecking project with respect to this clinker, we have already done. This was for particular kiln 3, and we have already submitted our application to increase our capacity. We are working on it.
Sorry, while the debottlenecking is done, the approval for the capacity approval is pending. Is this what you imply?
We are talking about two things. One is that the improvement of the kiln by doing the debottlenecking capex, that we have done it. But when we talk about the capacity for the government side to get the approval, that we are working on it.
Okay. And was there any so there is no grinding expansions or debottlenecking we have done. So grinding capacity remains 5.75, and while clinker we have expanded from 3.1 to 3.23, the official approval is yet pending.
Yeah, you are right.
Understood. And sir, Karnataka, the unit which you had, which is now defunct and usable, is there any plan to dispose of that land parcel? Does it have any monetization value which the company would be looking at?
So our Karnataka unit, we run, albeit it is the lower quantity, but we have been operating it.
No, because you don't count it under your capacity of 5.75, which we assume is 2.5 MP and Jhansi is 3.25. So that is why I was asking.
The capacity of the company is not 5.75. The Karnataka capacity of around 500,000 is also there.
So in that case, we are 6.26. Is this the capacity we have?
Yeah.
Okay. And there is no grinding debottlenecking which is happening as of now. Only the blending unit that you are setting up in MP, which is 0.4 million ton, which will come up by FY28.
Yeah.
Understood. Yeah, that's all from my end. Thank you.
Thank you. Participants, this is a final reminder, and no further reminders will be announced. To ask a question, press star and 1. We take the next question from the line of Jinesh Kothari from Equirus Securities. Please go ahead. Jinesh, if you can please unmute from your end and proceed with your question.
Hello, am I audible? Hello?
Yes.
Hello? Yeah.
Yes,
Hi, sir. Can you please provide me with your clinker sale number for FY26 and what was there in last year, FY25?
That is part of the total sales volume. Already we have reported total sales volume, cement and clinker put together.
Sir, I wanted clinker volume separately. If you can please quantify.
Difficult to share that number.
Fine, sir. Thank you.
Thank you. We take the next question from the line of Nagaraj Pipali, an individual investor. Please go ahead.
Good afternoon. Am I audible?
Yes, you are.
Yeah.
Yeah. Sir, my suggestion for the company is instead of going for dividends, very good dividends you are declaring, why don't you go for share buyback, which will increase the shareholders' value in the long term?
Okay, we have noted down your suggestion. Maybe we will explore in the management committee and we'll discuss in the board of directors meeting and we'll see. Dividend we have declared or we have recommended by the board and we will submit before the shareholders for their consideration and approval. But at the same time, we'll check the share buyback proposal.
Okay. Thank you very much. Good luck.
Thank you. We take the last question from the line of Shravan Shah from Dolat Capital. Please go ahead.
Sir, the total for the company as a whole, total capex for FY27 and for FY28 would be how much?
The total CapEx we split into two parts. One is our, you can say, sustainable CapEx, stay in business. That is in the range of around 45 to 50 crore rupees, and that we do every year, which is more or less 40% of our annual depreciation. And on top of that, we do some improvement CapEx. So today we discuss about this Khandwa blending unit, and there we are going to make it around 130 crore rupees in 2 years. So first year, if I take the maybe ballpark number of the 40% of 130, so around 50 crore rupees another. So for the fiscal year 26-27, it will be around total 100 crore rupees, and next year, subsequent year, it may be around 120.
Okay, got it. And sir, did you able to get that blended kcal cost?
I will check it and will let you know.
Okay. Thanks.
Thank you.
Are there any other questions?
No, sir, there are no questions in the queue. I will hand the conference over to Mr. Vaibhav Agarwal from Phillip Capital India Private Limited for closing comments.
Yeah, thank you. On behalf of Phillip Capital India Private Limited, we'll thank the management of HeidelbergCement India Limited for the call, and many thanks for participants joining the call. Ryan will now conclude the call. Thank you very much, sir.
Thank you. On behalf of Phillip Capital India Private Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your line.